This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. It's a Monday morning, starting a fresh new week. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Morning, Nigel. There was so much sporting action over the weekend, right? After all of that, I mean, of course, the India victory against Pakistan, but also the way Afghanistan played yesterday against England, right? It was breathtaking to see their win. So I guess all eyes will be on what happens next.
But our boys played fantastically well. You know, a bit of a damn squib actually for those who went to the stadium, because you want to go and see 100 overs or at least 95 overs. When you get to see 70 overs, I think you feel it's a bit of a raw deal. But full marks to our boys. Came up with a top performance, and now we feel that we have the momentum with us. England, I think, we're used to it, right? 2011 Ireland, 2015 Bangladesh, and 2023 Afghanistan. So they never fail to disappoint.
I think people sitting at home also got, a little disappointed with the way the India-Pakistan match got over so early, right?
The pizzas and,
by the time the food came, the match was over.
The pubs would be disappointed, right? I mean, all cover charges and bookings and everything, and then you have this short match. By the way, guys, it's also, I think, the beginning of the Navratri period. Yes. So wishing all our viewers a very happy, auspicious, prosperous sort of beginning of the festive season. And this is the period which marks that. So wishing all of you the very best from all of us here. Well, let's just begin the program then with a quick look at what you need to know as we begin today's trading session. And I'll just start with the big things we saw on Friday, and we actually did see quite a few big things. What am I talking about? Oil prices, gold prices, and the fear gauge, so as to speak, which is the CBOE Wix, all saw very large move. I mean, these moves that you're seeing on your screen will fall within the top 2-3 percentile of what we've seen in 2023 so far. So oil went up 6%, 90 plus on that one. Gold prices went up some almost 4%, above 1900. And the Wix, the fear gauge, went back above 19 odd levels. So it kind of shows you the market kind of thinking, the market setup on Friday, especially, I mean, actually the start was good, but then once the sell-off happened, things never really recovered. Now, U.S. equities were weak as well on your screen. So Nasdaq was the weaker of the two, down about 1.2%. The S&P was down about 0.5%. And yields have been all over the place. So I could tell you what happened on Friday, but I think it's better to take a slightly zoomed out snapshot. The 10-year in the U.S. has lost 18 basis points Friday to Friday. Right? It's down, it's not up, it's down. But what is the reason why yields are actually selling off? And this is, of course, a theme we've highlighted for some time. But the reasons are always different. So there was exceptionally dovish Fed speak. Again, something which we highlighted middle of last week in terms of how many Fed members, and these are people who actually have a vote on the FOMC, the rate setting committee, saying that because market rates are going up, that is doing the job of what we are supposed to do. So we actually may not need to do too many rate hikes, because interest rates are already, market interest rates, that is yields, are already high. So that's offsetting the need for hike from the Fed. And I think that is essentially the one big reason. By the way, there are big economists who were expecting a hike in November. I mean, there were a few that, they've pushed that out, saying that, well, because of this, it's very unlikely that the Fed will make a move in November. The other factor why yields sold off is also because of geopolitics, right? I mean, the war in the Middle East is still very much on, the conflict rather, and yields sell off. I mean, we've showed this during past instances of conflict in the Middle East as well. On an average, yields in the US sell off 20 to 25 basis points. So it kind of sort of, ties in there as well. Over the weekend, now that we're talking about geopolitics, you had U.S. officials. There were reports that U.S. officials are actually in conversation with the countries there in the Middle East, and they're also perhaps back-channeling with Iran to try and contain the conflict. I think at the very margin, this may be a little positive, right? I mean, the fear is Israel has kind of put it out there that this is going to be a long, drawn-out conflict. But the bigger fear is that this kind of becomes a proxy war and other players in that region get involved, and this becomes much larger. So I think these efforts over the weekend, as we sort of learn, I think at the margin perhaps will be seen as slightly positive. Let's just sort of tie all of this back in terms of where we are at in terms of the market. So on Friday, the Nifty ended above the 20-day moving average, which is at about 19,724. The first resistance for the Nifty comes in at about 19,843. You know, that's the recent high. And then you have to take out the 19,883. I mean, around that level, that's also the 61.8% retracement. So 19,800, 850 is essentially what the market needs to take out for, some confidence, etc., to come back. And the support of the rising trend line for the Nifty, which stands at about 19,650, about 100 points away from where we left off on Friday. Unlike the Nifty, the Bank Nifty failed to see any substantial recovery on Friday. I mean, actually, it was a much weaker index. So resistance there coming in at 44,757 and then 45,54. So a couple of percentage points away from where we are right now. So that's 44,757. That's the first one. And support there comes in at about 43,900 levels. Again, not very far away. These are very near-term numbers that we're talking about, so as to speak. So, I mean, I think it's a pretty, I would say it's a pretty confusing kind of situation. You could kind of say that, well, you know, buying the dips has been the right strategy and it has worked, and absolutely that would be the case. But you know, the thing to try and do is to buy the bigger dips, not very shallow dips, but if you get larger, steeper kind of dips, that sets you up, especially in a trading kind of environment, with better risk reward going forward. Otherwise, I mean, I think the situation still remains pretty much in a flux with what's happening in the US and, of course, what's happening in the Middle East as well. Sonia.
Absolutely. You know, I think the bias is definitely on the downside. I mean, what you saw last week, and even, if you just break up what's been happening in trade, the problem is with the heavyweights. Although the mid and the small cap end of trade is absolutely fine, I think today, as we begin trade, the GIFT Nifty is suggesting a fall, right? Almost a 15-20 point fall. That's largely because of what's happening with crude. As we mentioned, there was a big rally in crude. Brent is now above $90 a barrel. And there's also talks of, the regional energy production being affected because of perhaps further escalation of the situation with respect to Israel and Hamas. Safe haven assets like gold have also rallied. So there is a risk aversion towards equities as all of this plays out, and nobody knows how large the situation could turn out to be. Hence, there is this move towards safe haven assets like gold, and you've seen a spike in crude. All of this is reflective on the index as well. If you just map the last 1 month, the Nifty is down almost about 400 odd points, and now just at that 19,750 mark, slipped below 19,800 as well. The flows have thinned out too. So FIIs barely bought about 370 crores on Friday, while there was selling by DIIs. Now, a couple of big things to watch today, which could maybe, help with sentiment. One of them is HDFC Bank's numbers that come out, and this will be the first quarterly earnings post the merger. So the numbers could perhaps be volatile. A couple of things to understand would be the opening cost of funds, which will be closely tracked for HDFC Bank post the merger. So that's a stock in focus. Remember, the stock is down almost 8% in the past 6 months. It's been a bit of an underperformer. So let's see which way this goes. There are other big earnings this week. There's Bajaj Finance, Bajaj Auto, Wipro, HUL, Paytm. All of these companies come out with their earnings. So we'll keep tracking those very closely. And because of the surge that we've seen in crude, this disproportionate surge, you could see a negative trend on paint companies, tire companies, aviation stocks, etc. So all of these companies will be in focus. And then names like Avenue Supermarts as well have given unimpressive numbers this time. But, the problem really lies with the large caps. And now, because of what's happening across the globe, it's a bit of a drag. It's also an earnings-heavy week in the US. So lots of things to negotiate this week.
Well, that's right. So actually, the global cues are a little bit worrying. You look at the markets, or you look at the cues that you're getting as well. Otherwise, it's quite worrying out there. And for us, the Nifty Bank actually has been the weak link. And there have been some short positions that have got added on as well out there. But what could change things is HDFC Bank. Last week, in the last 3-4 days odd, we've seen periodically there has been some buying. But even in Friday's trading session, if you bought that dip, well, that got sold into as well. So those are the big three factors that I'm looking at. And there is some caution on board. Why do I say that? Because CBOE Volatility Index, well, that spiked up close to around 15%. You had gold prices as well that were up close to around 3.5%. And Brent crude prices spiked up close to around 5%. The combination of these three, with all these three spiking up, we haven't seen that actually in the last many, many years. And I believe so, we haven't seen this sort of a combination in more than last 10 years or so. So that's a bit of a worry, particularly when gold spikes up. That's telling you that the street is a little bit cautious, or the investors are cautious on equities across the globe. What happened back home then? You had the Nifty that ended lower. There was some unwinding of positions on the Nifty open interest side. The Nifty Bank, well, you had a spike up in terms of open interest out there, was up more than 10% odd. And what did the FIs do? Well, they added some shorts, and they added more than 11,000 short positions. And it appears most of that shorting was done on the Nifty Bank itself. On the option side, they bought more puts than calls, and they wrote more calls than puts. So that's a little bit of a bearish skew that's coming in there. But two strikes were very, very active. 19,700 call, 19,700 put. Between them, both of them, each of those strikes added more than 25 lakh shares. And the premium, the combined premium of both those two is close to around 200 rupees. There appears there's a short straddle playing out at around 19,700. What is that? You write both those two strikes at around 19,700. You pocket that premium of close to around 200 rupees, and you're playing for this broad range. 200 minus 19,700, 200 plus 19,700. And that's the broad range you're looking at. On the Nifty itself, what are the near-term cues? Well, the 20 DMA, that's the mark that will get tested. The 50 DMA, that's the line in the sand. You don't want it to break that level. Otherwise, maybe we could correct to around 19,350. And on the upside, the recent high that we saw last week, 19,850 or thereabouts, that's a crucial factor. For the second half of trade, HDFC Bank, the rank underperformer year to date. You pull up a graph, that'll tell you the picture. HDFC Bank has underperformed the Nifty big time year to date. That's an underperformance of close to around 15% odd. Can they deliver a bit of a positive surprise? Can the commentary be good? Well, that could turn things on its head for the second half of trade. So that's going to be important. For starters, though, we pull back a little bit.
All right. Well, as we speak, the Asian markets are also under pressure. So the Nikkei market, the last time I checked, was down almost about 2%. A lot of pressure coming in over there. So let's begin the day with some views on the equities front. You have Vikash Jain of CLSA, who says, after 6 months of inflows, India saw outflows of $1.8 billion from FIIs in September, driven by non-India dedicated funds, while India dedicated funds continue to record inflows. He says FIIs cut their relative weight in financials, energy and materials, and they shifted into IT, utilities, communication and real estate. He says this FI selling was more than overshadowed by inflow into domestic mutual funds of $2.9 billion, still down month on month. Vikash adds the systemic investment plans saw record inflows of 160 billion rupees. He says domestic investors continue to redeem large cap funds and move into mid and small caps. He says due to its attractive risk-reward profile and defensiveness, they add ICICI Prudential Life to their India-focused portfolio and notably raise their insurance overweight sector view.
Okay, well, let's get you some money market views as well. This is B. Prasanna of ICICI Bank, who says the dollar remains strong owing to safe haven buying on account of geopolitical crisis in West Asia and higher than expected inflation print in the US. He says along with a strong dollar, firming crude prices and FPI outflows in equity markets are keeping rupee under pressure, which is protected from further depreciation by RBI's forex intervention. He expects to continue, he says that the rupee may trade in a narrow range between 83.05 to 83.55 to the dollar in this week.
And on the bonds, B. Prasanna says global yields continued consolidating despite higher than expected inflation prints, largely owing to risk-off sentiment emanating out of the ongoing crisis in West Asia. He says local yields recovered marginally from recent highs on the back of strong investor demand. He adds the uptick in crude prices and announcement of the open market operation sales by RBI remains the key risk to watch out for. He also expects the 10-year benchmark bond yield to trade in a range of 7.25 to 7.40%.
Well, we've got a lot of stock-specific action to track for you. We get to that in just a bit from now in our special Top 10 segment. But let's run you through the list for now. We're looking at Tata Motors, Dalmia Bharat, Suntech Realty, Laurus Labs, PVR Inox, Bajaj Electricals, Texmaco Rail and ONGC, all of them on positive news flow, while we have Avenue Supermarts and Delta Corp that could be reacting to negative news flow.